What happened on Friday was not what anybody really expected to have happen. So I want to show you how I view the world and what I like to do on events like this. I just break it right down to the bone. So what I tend to do is just go right here and just go open, high, low, close, and just look at the world. And I just look at what's happening on a chart with nothing more than that. And if I look at the S&P, we can see that we have some levels here where we have a breakout, and then we have that failed breakout. Now, the VIX is doing something really, really weird. Bitcoin's doing something that is definitely a signal that we have to pay attention to. It's unmistakable what it's doing. We have to go through NVIDIA's earnings and what happened there, and then that rotation in the software in China and how real it is. So there's a lot to get into. There are parts of this you are definitely going to want to watch again. But when I look at this on the S&P, to me, there's your breakout. Here's your where you're supposed to hold, just so we get it. You're supposed to hold that breakout. Here's the previous bar that's supposed to hold, and you've undercut that already. So you would view this on very simple terms as a failed short-term breakout. You would not use this bar because that bar did not break out. This bar broke out. This was rejection. Is this just get me out of the way for Labor Day and then we're going to come back to it? I'm not so sure. If I take a look at the Qs, which I think is really important to do, you can see your breakdown from that August level, your rally back up, your retest of this area, and I'm just going to drop it like it's hot right there. And you can see that retest right in there. So you're like, oh, good. Well, we held. Well, where did we go to? And then all you would do is take the top of that bar. And the top of that bar, that breakout failed. So now I have not only a failed breakout, but what else do I have right in here? And you can see it yourself, right? So all we're doing is just looking at price and just reading open, high, low, close. This is how I learned to trade. So when I try to figure out what's going on, I find great value in just breaking it down to the basics and just looking at it and going, oh, okay, so now I have this kind of wedge area and we can look at the moving averages and all that. That's great, but you're in a trading range and you've been in a trading range all of August, candidly. From the breakdown and the measure of that breakdown from here to the rally, it's pretty much the same, getting tighter and tighter. You guys see that just by looking at it. But what you don't have, and I think that this is super important, is you need to understand that this bar right here is in control. And right now you've broken below it, tried to rally over it, and it pulled you back in. You broke below it and it pulled you back in. So when you get confirm moves under this, which are going to be established by a break of like 558.41, or you get a confirm move here above that is exactly that 579, 79, then you're going to have an issue. That's going to be your confirm move. Until then, you're in limbo and you have a lot of data telling you that you have a problem. 27.5% of you do not subscribe to this channel. Please subscribe, click all notifications, and let's get into it. Now, in front of us is the VIX. And for those that don't know, the VIX is just a combination of the volatility expected over 30 days. So when you're around that 15, just you can remember it this way. I guess I can type it out real quick. You're right around that 3.5% area if you're around 15. If you're around the 20, you're around that 5% area. And then you just kind of look at it that way. If you're 25, you're going to say that you're at that, 7% area, and that's at a 25. And then if you go here, and then you'd be at a 10% area, anything between like 30 to 35. And this is back of envelope. It's a lot more technical than this. And let me just actually blow this up so you get it. But this is why people look at the VIX. Like people always like, well, who cares, right? The reason you care is because when you have a VIX number, it's actually equating to you what the market's supposed to do. So when you see something that's out of alignment, you want to pay attention to it. And we're out of alignment. What's going on is not making any sense. And that always is a concern of mine. For example, market's selling down, but the VIX is dropping like a stone. If we even took a second before we come back to this and take a look at MOVE, and we see how MOVE is going, MOVE is falling off a cliff. That's not the MOVE I want. Hold on. There it is, the bond market volatility index. If we take a look at MOVE, it's completely imploded. Now, MOVE is to the bond market what VIX is to the S&P 500. So if you're worried about your bond portfolio or your high yield bond portfolio, you buy MOVE, and MOVE gives you insurance on the bond. So it's a combination of all the insurances out there. So when you look at it, and we'll just take this period of time, you're actually breaking lower. And the reason for that is because they're going to cut rates. And that's where this is all heading. So what do we do about this? And what do we do about the fact that they're cutting rates? And so the bonds are coming in, and we know that this leads to, the market and the treasury. And this is why you're not getting over 4.5. What does all this have to do with the VIX? Well, this is where it gets super interesting to me, because the VIX in and of itself, when we look at it, what is it really doing? It's not able to rally. It's not able to get above there. And when it can't get above there, it's definitely something like it just can't get going. And when we sell down on days and it's not rallying, we must pay attention to that. And there's a couple reasons for that. Just grab this so you can see it. Number one, let me just put that up there so you understand. And that's within a 30-day range, usually. That's why when you'll see these guys come out, you can just write this note down. Whenever you see the VIX over 40, anytime the VIX is over 40, long-term investors, institutional long-term investors just start buying. And if historically, I'll go off on this one tangent and then we'll bring it back home. But if you had a level of 40, if you ever look at the VIX and you just kind of come through this level, and we'll just drop it down, drop it like it's hot. And you marked off these on the S&P and you bought and forget that you owned after there. And you were looking like out like 3 months to 6 months. You just bought the index. You've done fairly well. You can't look out and say, I'm buying it today and I'm going to look at it Tuesday. You'd have to buy it there and say, I'm going to look at it 3 months, 6 months, or a year from now. Those people that did that, they've done quite well historically over time. And that's just the 40 level because it's so extreme, right? They're just baby out with the bathwater kind of stuff. So what we're looking at today is kind of the exact opposite, isn't it? Because we're just buying and this isn't going anywhere. And it's getting to the point like, oh, don't worry, everything's fine. Well, when the market drops like this, it's telling us one of two things, like it did on Friday. Why are we dropping like that? Why are we reversing right away? Is this something more systemic? Is this something that has to do with the tariffs? Is it something that has to do with the market? Or is it just options expiring? And historically, when you look at August, you're supposed to rally a little bit in the VIX. Like when the market sells down, you're supposed to rally. So I'll show you what I mean by this. And this is really important because something's off. And I'm trying to figure out what it is. And so we've had this reversal. We've had this huge move. We've had this huge breath going, but something's definitely off. And we talked about parts of it, but this part of it where, let's get rid of this because it's bothering me. But this part of it's really vexing, I guess is the best way to say it. So here we are in August and we're just hanging out. And then if we just went back to another August time frame, you'll see, obviously you have this move in August here. And this was pretty extreme, but that was Japan cutting their interest rates or raising their interest rates for the first time. But again, if we just go through time and go, okay, well, here's July 23. And if we just took this area as well, you'll see that there's an area in here where it does get heightened going into August. It's, from July to August, it went from, 13 to 18. And it's not just one time where it does this. It does it consistently. Here's July, and then we're in this kind of August level. And then what's it do? It kind of rallies up. People sell, they go away, whatever, right? Okay. And then you have this huge spike in this one from 19 to 33. And then we would obviously know that you have that again in 20, but we're not going to go through 20 for obvious reasons. But then here you go again and go, all right, well, here's August again. All right, we have this little spike up. And then we have this little suck salad where we're not doing anything. And again, why do you care about this? Why do you care about the VIX? Because the VIX tells you where you're going to go. So the VIX is telling us like, hey, don't worry about it, man. We're not going anywhere. Where these moves, we're saying, hey, we're probably going somewhere. So the way you have to look at this is two ways for me. Number one, we have to look at the VIX and say, is this coming? And how come when we sold off and we sell off even a little bit, we're just not really moving in the VIX? That's really becoming a concern of mine where like, oh, we had this little move July 1st. Okay, we had one day. We had one day of it and then it came back. So this is definitely on my radar. And I'll take a look at, I'm going to show you some statistical data here. Now in front of you is seasonality of the VIX. And that, and we'll go to this and click over here. And what you're going to see, super simple. Here's the average of all the years that's in blue. And here's where we currently are at. So here we are in red. And here we are in blue. So historically speaking, when you get to this kind of 130, 140, it starts kind of creeping up. And then towards the end of the year, it starts dropping back down as people start levering back in and prepping for the beginning of the new year. That's not what's happening. What's happening is it's continuing to drop and it's an average. So could this continue to happen? I mean, of course, because it is happening. But we came from such this, this kind of move already, right? So you are working that off. You're not seeing any fear here at all, like zero. And I think that's super interesting to me. So why are we not seeing any fear? And what does this really mean? Well, when I see things that are that off kilter, it does give me a little bit of a pause. Like, okay, well, what do we do about this? Now, to be really clear, this all depends on your time frame. If you're day trading, this really does not matter. You just take the day as the day comes and you trade what the market gives you and it goes on. If you're swing trading and you're long-term trading, this can kind of add to it. It kind of explains why you've been swing trading the past week and probably past 2 weeks really. And it's been very difficult because historically things are thrown off. And I would think that anybody, unless you're in the energy names, you have a couple trades out there that are working, sure, but there's no follow through. And we're seeing that. Now, I'll show you what I mean by that in a little bit, but let's get to this. Now, in front of you, 1 month, 2 month, 3 months, 4 months, 5 months, 6 months, you can see it. And where I'm going with this is just understand what you're looking at from a time frame right up here. And what you're getting is the average. So I want to show you the max and the minimums, but these are showing you the, where you're at as far as like, where did you close? But what we also want to look at is the max and the minimum. And I thought this was really interesting. So why is this interesting? So here's the Z-score. And whenever you're looking at something, see what happens here with the Z-score and how Z-score falls off, how these are negative, and then it goes over here. If you want to wrap your mind around what is a Z-score without me going through this long dissertation of it, all you have to know is that a Z-score is very similar to a standard deviation. I'm saying similar, so those that know it's not are not going to put a comment below. What I'm getting at is, if you think about it from a standard deviation, one standard deviation is a 67% chance. 2 is 95, 3 is 99.7. So whenever you see a Z-score that is 2 or greater, you want to pay attention because it means that it has statistical significance. That's it. That's all you need to know. You see a Z-score, if you don't see a 2, in my opinion, or you see the high 1s, you're like, okay, well, this happens all the time. It's not that big of a deal. So when I see something like this, or over here, and they want to tell me that 71% of the time or 86% of the time we go higher, cool, but so does the market. So you're not really giving me anything that's out of the norm. So what that means to me is I have to look, when you look at charts like this, you always want to look at the Z-score and then say, where's the statistical significance in the data that you're giving me, right? And if people are in this field know that stuff. But anyway, so you'd have to say 1 and 2 months are of statistical significance because this is my Z-score. And I've done a video on how to calculate Z-score. I'm not going to bore everybody with it again, but just think of it as standard deviation. It's very simple. So when you look at that, you'd go, okay, so this is where the significance is. And then you would look and go, well, the mean is negative 1.1%, negative 2.3%, and here's your median, and here's the chances that you're going to be positive. Now, I don't have 30 data points, which is what you need for statistical significance. I can only get to play the hand that I'm dealt. This is what I'm dealt. This is what I have. Here's what's so fascinating to me about this, though. A low VIX, and this is why I wanted to share it with you. A low VIX usually means, oh, we're good. Like, don't worry about anything. This is telling you quite the opposite. It's telling you quite the opposite. Hey, when this happens, the market comes in. And what's interesting is, since 1991, when this has happened, there's only really been 2 times where you've been positive 2 months later. So historically, it's telling you that, and this is why we always have to look at this stuff from a tactical, strategic standpoint, right? Depends on your time frame. Yeah, it looks like you're in for a bumpy ride in end of August, right, to September. That's what this is telling you. And then seasonally, you do pick up again in October, but it is telling you like, hey, you could be bumpy here. And we'll get into the technicals a little bit on individual names. And it does look a little bit like that, but take a look at this. So in front of you is the full data set of those days. And what it's showing you is the max loss and the max loss here 2 months later, and it's showing you the max gain. So why this is important for me to show this is when people look at this data and then they go, oh, but the market went up. Well, what you should be taking from this data and how I would use this data is when the market's rallying and you're looking out 1 to 2 months, and historically this happens. And if you were to use this data in context of trading, you would say, well, I'm selling the rallies because historically this is the time to sell the rallies, right? It doesn't mean that that just because it's down, it's going to go straight down. It's not, there's nothing linear about the stock market. If you've been trading, you know this. So what you have to do with data like this is saying, okay, this is the important data, and this is going to tell you exactly everything where, here's your mean, your median, your min, and your max. And it's telling you like, hey, 2 months later, when we were up 4%, that was it. So if you were up 4% 2 months later, and at one point you were down 8.5%, and then you look at where your average was, you went up 4% and finished at the low. If you go back and look at the other slide, if you go take a look here at the mean and the max, you'd be like, yeah, we closed near the low on the last month. So it's telling you that a month later, by the end of September, that you historically will see some rallies, but then you roll back over. So historically, what it's telling you is that yes, you will see some rallies, but then you roll back over. The rest of this data, I don't really care about. And I'm just going to say, why I don't care about it again is because the Z-score is not something of significance. I hope this makes sense. If it does, just comment below that says, yes, this does make sense, or no, go into greater detail. I'm trying to show you the things that you should actually look at instead of somebody just pointing at a graph and saying, oh, well, this is what's happened. If you understand like Z-score and standard deviations, you can actually say this data means something to me or this data is garbage. And I'll show you what I mean by this very quickly. So here's the NASDAQ 100, and it suffered its 5th straight down day after setting multiple year highs. And that doesn't bode well for the coming weeks, with QQQ showing a 36% rate, right? And so you'd be like, wow, that doesn't bode well. Because he's got these arrows here, and then you're looking at it and you're saying, well, that really doesn't bode well. When you hit this, yeah, you kind of come back down. All right. Okay. And then we look at the data. Now, the first thing that you should be looking at when someone presents data to you is going, well, where's the Z-score? Well, here's the Z-score. So if I was to look at the Z-score, the first thing I would say is, I don't really care what that's doing. I don't care what this is telling me about a day later, 2 days later, 3 days later, a week later, 2 weeks later. Maybe I care about what happens in 4 days, maybe, because I have a 1-2 Z-score. Other than that, to me, this comment above where, oh, when we go higher, we're definitely going to come down, doesn't hold statistical significance, because the Z-score is saying, yeah, it's pretty much what happens in the market all the time. So there's no correlation. You see, just because something happens doesn't mean it's correlated. A Z-score tells you if there's a correlation, and that's what it's telling us with the VIX. That's the difference. Now, it's no secret that there's a high correlation between Bitcoin and crypto and the market. And a lot of people are wondering why the altcoins aren't moving. I'm not doing all that. And what I want you to understand is that I do think that there is a correlation between risk assets and Bitcoin. And I do think there's a correlation between Bitcoin and really even Ethereum, but mostly Bitcoin leading what the market's going to do. And you can really overlay the market with this. So if you just went and did something very simplistic, and you could actually do it with the Qs too. But if you were to look at just the market and just overlay it, you can see it yourself. You can see that, this is pretty interesting stuff. But what I tend to look for is leading indicators. And I'll show you what I mean by this. So if I am to look at the S&P here, we can see that the S&P rolls over in February when we get liberated and liberation starts. And if we take a look from here over and we just look straight across, we can see that you peaked back in January on Bitcoin. And then it took a period of time from February on before that we actually had that issue. And I believe the true liberation started this day, and then he brought out a fancy sheet, and then we had more liberation. So then where I'm going with this is, if you look at the S&P right now and you look at what happened over here, it's very similar to what we are dealing with here. And it's not just this that you can do it with. You could also just do it with the Qs and look at the Qs for a second. And let's pop that back in. All right, there we go. Good. So, and we could see the correlation here. I mean, it's not rocket science, right? It's highly correlated. The S&P and the NASDAQ are highly correlated. And really, it's just a question of which one's having a better day for that moment, how that internal rotation is going. That's all it really is, right? And that's what we have to focus on. What gets me about this is that you're leading here. And I think you're leading again. So if I go to just a bear chart and just drop in the RSI, and I've been talking about this for some time, that your RSI is negative and your RSI is rolling. And my thought on the market, I'm going to get to in a moment, was that we were going to rotate into something different, meaning the market was going to rotate into software. That's where I was in the beginning of the week. And I went there based upon NVIDIA's numbers. And we're going to go down that rabbit hole. But what I want you to get from this is you have a negative divergence here. And I really don't care if you believe in negative divergences or not. They believe in you. So I don't use that peak. I like the body, right? Just like Mickey said to Rocky, go to the body. So then here you are, and you're watching that hit in here, and here you are watching it here, and you're going, that's a negative divergence. And they're stepping us down on that negative divergence. And again, RSI is the magnitude of the move. I did a whole video on RSI, and it was a while ago before I could even learn how to turn on the darn internets, and I should probably update it. But this is where we're at. And what I want you to get from this is you have a negative divergence. Just understand that. Like, you have it. So you might not like that you have it, but you have it. So if I was to go back and look through time and say, well, how did this work before? 1, 2, 3. Okay, so negative divergence. You can see the higher highs here, and I'll get rid of my cup and handle. And you're sitting at the handle, so just understand that as well. And you actually crack the handle. Pop goes the weasel goes pop. So if we look at that, that's third base for you kids that don't know. How do you not know who third base is? So you see where I'm going with this? And then all of a sudden it pops up. And it doesn't mean that you're going to fall off a cliff. Where I think that this could go to maximally is that you're in a position here where you're probably going to go back to whatever it costs to mine a Bitcoin because of the futures market. And they step in the futures market. So back here, I think it cost 49 or 50 is what it was costing. 49 to mine a Bitcoin back here. And there's probably charts that you guys have that watch this stuff that tells you what it truly costs to mint Bitcoin. Now, you've had utility costs go up dramatically because of the data centers and how they're, that's why everyone's looking at their utility bills and goes, what's going on? Well, thank Microsoft, Amazon, Meta for that, because they're sucking all the power out of the market. That's why your utility bills are higher. So when you start to see this with the data centers and everything, that means the cost to mine is also going to go up unless they're near, water or something like that, right? When they're using other different kinds of power. But that cost is going to put a bottom on Bitcoin because they're going to buy the futures, which is what futures are actually for, to hedge that. But if you look at these levels and how this goes, it usually comes in fairly decently. So what we would do is just go back historically through time, and you'll see them where you have these drops in the RSI, and then from those drops you'll have a peak, and then you'll come back down, and they're all telegraphed. I mean, you can see this one here as well, where there's the lower high, and then here you are, and then you have a drop. And unless you have FTX coming in, I don't think you're going to see that again. But they're everywhere. Like you literally can't miss it. Since it started back here in 20,000, you can even see the one, and might as well just do it again. You can even see the one right here where it dropped. Let's blow this sucker up so that you guys get it. And you can see that right there, right? So all of a sudden, you have, and we'll just mark it off right there so you can see the high. And what's funny about this too is this is actually when they created the futures market on the SIBO for this, which is kind of interesting. I marked the peak here, and it was because people could finally hedge. Come on, work with me. So if we click here and you see that, right? See it? All right. And I think that's super important to get, because it's not once that it's happened. It's all the time that it's happened. And when you say it over and over again, you can't unsay it. Really important concept to get, guys. And when you see this kind of thing happening over and over again, you can pretend, oh, it's not happening. This time it's different. Whatever, man. It's not different. And it doesn't mean that you're going to fall apart, but what you would do is measure the move out from where that peak is. Historically, if you look at them, from my perspective, like you said, okay, well, where's that peak from? Here we are, and then here's that peak. That's why this one failed. And you came back down, you're looking at like a 30% correction in some cases. Some are much steeper. Some are like 80%. So you could blend them together and say you're going to have a 40% correction. I think you have to look at the other external circumstances. I don't think you can look at it that way. That was 74, but this is when you got FTX'd and he was, altruistic and going to save the world. So, we have those kinds of corrections and you'll see them, but can you really look at this and say, hey, it's going to be just like this? Well, no, you didn't have Coinbase, you didn't have institutional ownership, you didn't have ETFs that were going to suck this up, right? You didn't have seller that's going to buy it on every dip. So where does this leave us? Well, I think it leaves us with Bitcoin and wanting to watch Bitcoin and do it this way. So I'm going to clean all this off. And really what I think you want to do is look at this on the short term and start looking to see if you're going to have short-term bounces. So when I look at something like this is still in order, and we are starting to hold this 4-hour level. And if you look at the 4-hour level, you'll just see these little bounces off of those 4-hour levels. It doesn't mean that you're going to like, oh no, that's the bottom. No, you need to break like a DTL, something like that. And usually these RSI DTLs will break downward trend line. When I say DTL, usually these DTLs will break before anything else. Now, you can't even clone this. And this is where this gets super dangerous to me, because people will look at this and go, oh, you're definitely going higher. But that's not even, I actually think it's even steeper. But there's your channel. You always clone them to see if you have a channel, and you do, you're kind of in the middle of that. But here we are, we're down at this area. And so what is this telling us? Well, this is telling us very clearly that you have a downward channel, you put it in the top, and here's your RSI and your negative divergence. So this is where you would have shorted it, right? And then you would look down here and go, well, I'm due for some kind of bounce. But candidly, you could get down to that 104 before you even say it. So I think that you have to take that into account. And the purpose that I'm getting at with this, even though I wanted to spend a little time on Bitcoin today, I look at this as a leading indicator to the market. And this is telling you that you're going lower. So we kind of can't pay attention to this and say that it's not happening, right? Can't really do the ostrich thing, because then, you're in the basement eating Hot Pockets. We have to quantify the risk and realize that the market's going to give us drawdowns, and it's our job as a trader to mitigate those drawdowns. Now, if we go and take a look at something like Ethereum, you're seeing the same exact setup, where you're rolling over and people are saying, well, you bounced from 3,200 all the way up, right? But you didn't keep score with it. So if I go and take a look at this on the 4-hour, you'll see the same exact things, where you're hitting these 4-hour levels and you're hitting areas of interest, and then you'll bounce and you'll rally up, and then you get this negative divergence, and then that's it. Now, candidly, I for sure thought you were going to break through 5,000. And I think the longest I've had in a while on Ethereum was right in here. And that's not what happened at all. What happened was that we just rolled right back over, and now you're seeing it follow the same playbook. What I would really watch from a standpoint of Ethereum, and I would be watching these even if you don't trade them, because they are telling you what the market's going to do. This breakout right here you've been holding. You've come down and you've tested that level. Rallies tested that level. So you'd want to watch that. But this is telling you that you're bouncing off of those levels. And the same exact thing here that you've seen is really important. Now, what I think you have to wrap your noodle around is that you've had a lot of supply eaten up here on Ethereum, because of these ETFs. And I'm going to call them ETFs. You can call them treasuries, but really all these guys are doing, and no matter how they polish, and put lipstick on a pig, it's still a pig. So there's a lot of froth in the market, and I'm just going to walk through this. This is no different to me than GBTC, like literally no different. People will say, oh no, it's a lot different. But GBTC had periods in time where it actually traded under NAV. Now in front of us with GBTC, I just want to show this. And I put this out there yesterday, and I've been telling the guys in the room this for some time. And I say guys in the general sense, I think the community is like 15% or 12% women, which is kind of interesting considering that the standard in trading is like 5%. It's kind of cool, really. Anyway, GBC divided by NAV is going to give you a graph. And that graph is going to show you that, can these break NAV? Well, GBTC has been around for a long time. And yeah, they can break NAV. Why? Because you don't own Ethereum. You own a treasury that owns, I would rather own Ethereum. And I'm going to get into this, but what I want to just make sure that you guys get is these things can trade at a discount because you don't really own it. They own it. Now, when they trade at a discount, you want to buy them. This presented huge opportunity. And so I'm showing this for two reasons. One, as a cautionary tale, is they like to remind me in the room when I showed this stuff. They're just like, all right, whatever, boomer, just the old man shaking his hand at the cloud. But sometimes pay attention to the old man shaking his hand at the cloud. There's something here, guys, and you're going to want to watch this stuff. And I think that this stuff's the canary in the coal mine, to be honest with you, that if this stuff starts breaking NAV, you can see how it's all tied together, right? So we started with the VIX, what the issues are with the VIX. And I think that this is really important to get. So let me just, let's take a step back so you see where we're going. Let's take a minute here and go through where we're at so that you can follow along, right? Sometimes this is helpful to just kind of regroup. All right, the VIX is below seasonal norms. That's really weird. And usually that leads to complacency in an area where there shouldn't be complacency, and that can become a problem, right? Historical performance based upon this is that the S&P is a issue, right? When this happens, there's a statistical significance that is proven in that data, even though we don't have 30 data points. Bitcoin's a leading indicator, period, end of story. Bitcoin has a huge high correlation, and Bitcoin has a negative divergence that has marked the top since they've been tracking it back in the day. Crypto treasury demand is increasing speculative excess. That's the stage that we're at right now. All these are pointing to, hey, you might want to start paying attention to crypto and the canaries in the coal mine. So I have our example of GBTC, and if you look at this, it can break NAV, and then people try to figure out and they never want to buy it when it breaks NAV, but that's really when you buy these things. So in this period of time, if you look at that previous graph, you actually broke NAV back down in here. And when it broke that NAV, this thing was $7. Nobody wanted it. Everyone's like, oh, this thing's going to be a disaster. They're going to have to liquidate. It's going to go to zero. Okay, you're up tenfold. You're up tenfold in it. When you don't want to buy these things is when everybody else wants to buy them. You want to buy them when they break NAV. And the bottom line is SBET, for example, from what I'm reading, like they want to buy as much as they can at NAV. But you have to understand something. And I've stated this for months. If you've been watching this channel, it's why I always say, subscribe and click all notifications, because I link all this stuff and we follow up on it, which is very differently than me just pointing something out and saying, see, I said this was going to happen. They're all linked. They don't go anywhere. If you look at something like this, they're selling stock to you. They're literally selling stock to you to go and buy crypto. So like, for what reason? See, at least GBTC did it differently. GBTC went to what GBTC did was they went to the Chamas of the world and said, hey, you have Bitcoin. Do you want liquidity? And they said, yeah, we'd love liquidity. And they're like, cool, put it in this treasury. We're going to store the Bitcoin here. And now you have liquidity. Oh, okay, that makes sense. What they're doing, what SBET is doing is taking a shell of a company, right? I mean, that's really what they're doing here. They're taking a shell of a company. I mean, look at this thing, for God's sake. How many different people have owned this thing? And they're taking the shell, and what they're doing is saying, oh, hey, I know you're a penny stock, but what we're going to do is we're going to go out there and sell shares, and we're going to go and buy Ethereum and Bitcoin, and it's going to be fantastic. And so they buy this thing, and then everyone gets all giddy, and then they sell shares to the public, and they take that money and they go buy a real asset, and you're left holding this thing, which makes zero sense. Because if you really wanted to own crypto, just go buy crypto. It literally makes zero sense. And it's completely different than MSTR, which actually has an underlying business and they use the Bitcoin and started to use the Bitcoin to hedge against the dollar and inflation. That's how MSTR started. Very different than what's happening here. And people somehow think that this equates to it. It doesn't. There's no need to comment on it, because I always say to comment, you don't need to. It doesn't. If you think it does, you're just not right. So if you take a look at SBET and what's happening here, they're going out there and they're buying what? They're buying a real asset. Ethereum, some could argue is Ethereum or Bitcoin a real asset, whatever. We're not going down that road. But this thing, when it breaks NAV, and it looks to me like it will, and they're not going to have enough money to substantiate or support it, it's going to be a problem, not a blessing. And then you want to take advantage of that problem and buy it. But in the meantime, you want to watch SBET, you want to watch BMNR, and you want to see how this is going to go. I thought it was super interesting last week. If you take a look at these movements that you've had from Friday on to this Friday, this is when everybody knew that Tom Lee was going to be on TV and talk about on the compound and talk about BMNR, and they talked it all up, and you got to buy it. It's the cat's pajamas. That's it, man. From the people that bought that day, they're down 20% already. So these things, as they grind down, they are your canaries in the coal mine. And what you're looking for is, do they break NAV? And people say, well, they'll never break NAV. They can. No one ever knows what's going to happen. They can. And if they do, that's a sign that you need to stay the heck out of the market. That's a sign that you want to let this thing flush itself out and go from there. Now, let's get into some other names. Now, let's take a look at behavior. And I think we'd be remiss if we don't take a look at NVIDIA. And if I take a look at something like NVIDIA, which is the leading stock on a percentage basis in the S&P, and we all know this. And if we look at what's happening here, you are having what? Say it with me, negative divergence. If you learn nothing else, you've learned negative divergence. And you can see it's clear as day, the issue from anyone that does any level of technical analysis. And as I stated earlier, one of the key things I like to do is I can just look at the bars. Sometimes you just look at the bars and just get rid of everything. Just watch the open, high, low, close chart. Get rid of all the noise. When you don't know what to do, just take it down to the bone. Just strip it all down to the bone and just look at the chart itself. It gets very clear what's going on. And then you just set levels based upon open, high, low, close. This is actually how I learned to trade without volume, without anything, just looking at what's going on. And it's very clear that from this open, you have not been able to get over that level. We can all see that. And then as you just get more advanced, you get more gadgets. But this is telling you that you're heading down, and you can see that you should be breaking this area. Now let's just get back to the candlesticks, because to me, they do add value and they do tell you things, but whenever in doubt, just rip it back down to the bone. So if you look at NVIDIA and how NVIDIA is acting since earnings, and then we do the simple things like the moving averages, I've got a 12-22 cross. And so what I tend to do with this stuff from a technical standpoint is we're going to get rid of the 55 for a second. And I just look at the 12-22 crosses and see, what do they tell me? Well, the last one was here, and then it went from 105 to 174. Okay. And then we're on a downward trend. We tried to flip it, and then it got rejected. And then we have another break here, and then it broke down from there, but it really wasn't really adding a lot of value. You broke here, down, and then we have this one. All right. So what we would see is that when they start to roll, the 12-22s, they start getting choppy, right? I mean, that would be the thing that we would take from it. It starts getting choppy to dropping, but does it mean that you're going to go through something major? No. But what we would see is that if we have a 12-22 cross to the upside, that's what we want to focus on. So the very first thing that we would do in understanding this and looking at this chart historically, since it came out and said, hey, I'm an AI company, is that the signal for us is not that this is just an outright sell signal, although this is telling you that NVIDIA is about to get really choppy until this remedies. So what we'd want to do, and you can see the cross right there. So what we'd want to do with that is say, hey, when we have a 12-22 cross to the upside on NVIDIA, we want to pay attention to it. But there are some things here that did cause concern on that call. So if I was to look at this as a trader and say, where are you going? I don't see how you're not testing the 168 level at this point, which means that the market will probably come in. And we've seen this rotation, or what looked like rotation this week, but I'm wondering if it's something else, and I'll show you in a second. But this is the canary in the coal mine after the other names. So you're watching the speculative excess and watching what's happening there. But if you start losing NVIDIA and you start losing the AI theme, and I'm going to just show you what some of the concerns are here. And I'm not going to say whether they're valid or not valid. I think you have to look at this from different lenses. So in other words, I look at this from a tactical standpoint, what's going to happen in a week, a month, and a secular standpoint, like, hey, what's going to happen in 5 years? I think if you don't own NVIDIA 3 to 5 years from now, you're kicking yourself. That's how I view it. You should do what you're comfortable with. So this is NVIDIA's data center revenue. And you can see in here from 21 over, they're just killing it, right? But we have this hockey stick. And then when this hockey stick starts rounding out, that's when it starts becoming an issue. 37 to 41, 42. All right, so 37, and you start seeing that 41, 42 level like up in here. We're going to get to the actual numbers now. But you get where we're going, that maybe, hey, maybe you're slowing down. And then if we take these data center numbers, which I've done and broken them out quarter by quarter in percentages, and I do look at this stuff in great detail because I am looking tactically as a trader, meaning, oh, I'm bouncing off the VWAP, I'm going to trade it for the day, to, hey, I own a long-term position in this thing. What the heck's going on here? And we'll see that we actually peaked on the stock for about 6 to 9 months when we go back to that second quarter. And this is percentage growth quarter over quarter. And what you have here, and this is going to freak people out. Long-term investors are going to freak out by this because this is the first time that you have where you've gone from 18 to 9 to 5. So your data center growth is slowing. And that might mean that it's time to start looking at the phase 3 names. We're going to get to that in a second, but understand that, right? That's what's happening. So maybe the CapEx money is going someplace else. Okay, but please get the concept that you have sequential decline in the growth rate. Not that it's not growing, but the decline in the way that it's growing is slowing. This is just a fact. It just is. It's not good or bad. Microsoft Office still sells Microsoft Office, right? It's still 10% off its highs, all-time highs from 40 years ago. So keep that in mind. And that's why you always have to look at this stuff, whether you're looking tactically or whether you're looking secularly. You have to make those decisions. So if you look at the revenue, right, they're just killing it. We were doing 16 in 21. That's when people say, well, in 21, it was $12. It should be there. Okay, boomer. Like now you're doing $1.30. So this is what you're doing in revenue. This is your data center revenue, 115. What you're seeing though, is that the data center revenue is completely encapsulating total revenue. And I created this graph to show you guys this. So if you look from 21 on, you would see that, about 40, 50%. Yeah, there's the 50% line. Why don't I just use that? But you're right around that 40%. And I also have it down here as like a line for you. And you can see it. You're at that 45 and you're like, oh, you're hanging in there. And you're like, oh, well, we flipped the 50. Okay, so we're a data center company now. That's 23. That's when it exploded, this move over the 50% line. You go back to that, March, May timeframe, you'll see the move. It never looked back. And now you're at 90% of revenues are coming from data centers. Well, if 90% of revenues are coming from data centers and data center growth is slowing sequentially, not stopping or going negative, slowing sequentially quarter over quarter, well, the growth story starts becoming more of a legacy story, like an IBM or something along those lines, right? That's not why people own it, even though historically I could get into why the stock's still cheap. That takes us back to this. What you're looking for is a test, in my opinion, of that 55, and I would just put an alert there, go from there, okay? For those that are listening, if you're still trying to get the community, please look this week for a welcome letter or an invitation to the waitlist. If you're on the waitlist, if you're trying to get in, look at the link in description. The reason I'm bringing it up again, why it's in the back of my head, is because then I'm probably going to close enrollment maybe for the end of the year because this is about to get pretty wild. I think September is going to be pretty wild and I need to focus. And I always give everyone the opportunity to do an onboarding call. So it takes up my time. I like doing them, but it does take up my time. If you look at something like what you're doing here, then we'd have to go and take a look. All right, let's start rocking and rolling. Well, what about AVGO? Well, you tried to rally, you failed, and now you're breaking again. So you're starting to lose some of these names. AMD, which people think is an AI company, but come on, who are we kidding? And you're getting these 12, 22 crosses. And then you could historically go and look and say, hey, how's that go? Well, I would argue that, and this is why you always look at individual names and don't just assume the same thing. Never assume. Did anyone ever tell you that? So if something was going to have a 12, 22 cross to the downside, you would argue that AMD does significantly worse than NVIDIA when you have a 12-22 cross to the downside. It is pretty obvious that this does worse, right? So to me, this is setting up to really come in pretty hard. I think that you could actually break the 55 here because when you have these patterns, like you're going to sit at that 156 level, but when you have these patterns, this is what usually tends to happen. So I would watch this very, very closely and see how this goes. But this could get, in my opinion, pretty ugly. If you're going to start getting out of the semiconductors names, these can get pretty darn ugly. If we look at something like a Tesla, you're not really going anywhere, right? But then you go take a look at something like a Taiwan Semi, and I've got a 12-22 cross, and I'm below the 55 again. I've tested it and I broke it again, and I'm rounding. So we are losing the AI names, and I pointed this out the other day. Here's ASOX, which is the AI Semiconductor Group, and here is ESOX. Yay. And ESOX is the equity weight. So if I equity weight them, I'm outperforming. So to see the outperformance, all I have to do is take ASOX and go ESOX and divide them and look at what you're seeing. Well, AI peaked over the equity weight back August 7th. And since then, it's been, we're going to buy some of the value names. Even those value names, and it's just relative performance, but you're going to see that they are holding up much better than the NVIDIAs of the world. Now, to me, I think one of the canaries out there in the coal mine, and I like using that phrase a lot, as you can tell, because I think it's important, is something like Marvel. Marvel, for all its purposes, this was a disaster. Like, if you're not doing well now, you're not doing well. So Marvel, to me, is something that could really come in very, very hard here. And I do think that this can come in all the way back to these April levels. Like, this was really bad, and they got it lower. So you have the software names out there that we have to get to. But if we take a look at Marvel and what Marvel's doing, it's not great. So we have the semis that are AI based that are slowing. They're growing, they're beating expectations, except Marvel and AMD, but NVIDIA, which is really the only company that matters, they're still selling, but it's slowing down. So that takes you to Dell, because now you need hardware. All right, so then Dell is the hardware piece. You have the chips, now you have to connect the dots. The connectivity is AVGO, right? You have the computing power, which is NVIDIA. I'm not gonna do a whole thing on it, but here's 10 seconds. Computing's NVIDIA, connectivity's AVGO. You need the hardware. The hardware is either Dell or SMCI, right? All right, got it, get it, good. So Dell comes out and guidance isn't great. SMCI comes out and says they need more time to file. Shocker. So you start looking at the hardware side of the market, and the hardware side of the market saying, yeah, this isn't great, guys. Like, I understand the CapEx is going up, but maybe the CapEx is going up because of the build out, or it's going towards power generation. And, we can get to that, with the power generation and what's going on there. We saw names like IREN move and then reverse, which is not great. You saw names like Affirm crush and then reverse. Not great, but I don't want to go off on that tangent. I want to stay on this tangent, which is the software names rocked because the adoption of AI is not going to the point where software is going to eat the world and AI is going to eat software. That's not what's happening here. That's not what's happening at all. Software crushed across the board. MDB crushed. Now, the question I have to ask myself about this and Snow, let me just clean all this stuff off, and how they're acting, and even how Crowd acted, which I was shocked by. I've never seen, if you go through this chart, like reversals like this. We'll see if it holds or not. And I do have positions in these. I'm absolutely shocked by this move, but it could just be options, and that's what we have to watch. Am I watching a short squeeze on software, or are we watching rotation? And this is the question we'll follow up with next week. So are we really seeing rotation into software like we did, or are we watching a short squeeze? And the violence of the move has got me wondering if I'm seeing a short squeeze. And it doesn't mean you can't make money, but that's the difference between trading tactically or strategically or secularly. If you're trading the software names because they're breaking out and you're thinking that this is where all the money flow is, and it's just people being squeezed out of their shorts, that's definitely a different trade. And you don't want to be left holding the bag. I think these names were so beaten down because everyone expected AI to come in and just eat their lunch, right? And you can see this with, CRM, which is coming out with earnings, and how CRM's been creeping up, Workday, all these names when they came out with earnings, right? That was really their bottom. And so what's happening is I do think some money is flowing into them, but at the same time, I'm wondering if we're seeing a squeeze. And I'll leave you with this. For example, like Baba, all of a sudden, they're going to come out with a chip that's going to compete with the H20, whatever. And I see like the war heating up, like the trade war heating up here on semis. But this is not really normal behavior for Baba. And we can say like, okay, well, JD tried to move. All right, well, did BidU try to move? Yeah, that kind of moved too the same day. All right, so are they really moving into China, or are we just watching one of these rotations again where they're going to squeeze? And then you look at the A shares that are out there, and the A shares are moving. So that would mean to me that you're really not seeing a lot of selling on, because A shares are mainland China, right? So you're not really seeing a lot of selling by them yet. And then, of course, you have like the Futus of the world, and then stable coins and how they're acting great. But we need to watch this very closely. Does Baba have follow through? Are they really buying, or did they squeeze? And then the second part of this is on the software side. Are these names really going higher, or did they just squeeze them for a couple days? Because if we lose the software names and they roll over as well, then we don't have rotation. What we have is just a short squeeze, and then we have to deal with the other issues of breadth in the market. That's it.